Welcome to Growth and Innovation Unlocked. I am your host again, Scott Hurst, and today I'm honored to have Russell Deakin, who's CIO and also the founding managing partner of Aceana Group. They are a single family office. They're focused on private investments across multiple asset classes, including venture, private equity, real estate, infrastructure, etc. And Russell, we're really glad to have you here.
My pleasure, Scott. I look forward to having a nice chat with you over the next few minutes.
Thank you. So to start, tell us how your career journey maybe led you to found Aceana Group, and maybe what experiences, like perhaps maybe in private equity or real estate or global investing, then shaped your vision. Is that's in your background, right?
Yes, it is. Well, I like to call myself a long lost Brit because although I am British, I actually spent most of my education in the US, and then that eventually led me to go back, funny enough, to go back to London, working at the time for Morgan Stanley and Merrill Lynch. And even when I was there, even though that was more on capital markets, I had always interested in venture capital, which was not very well known back then. So after going to business school at Anderson Business School, UCLA. Serendipity sort of struck. I had met my wife by then, who's Brazilian, and we moved to Brazil for 11 years, and which was interesting because I became a partner and the CFO for the family's real estate business. So we did commercial, residential, and land development. So that was sort of how I started to get involved with real estate. And then, really, a bit of serendipity. I was actually a board member for the International School, 5 years the treasurer, helped save the school. And one of the other board members was the CEO of the time of Brazil and Latin America's oldest venture capital firm. So we got along very well. We worked together very well. And then he said, well, Russell, we've done such a good job together here. Brazil was just going from the transition from hyperinflation to more normalized inflation, although it was still high. And he asked, is there any way you can help with our portfolio companies, teaching them about cash flow, forecasts? Because in Brazil at the time, there were not long-term forecasts for 2 or 3 years because of inflation. It just doesn't make sense. And I won't get into the details about that. So they were going through the cultural shift. And that led me eventually to be asked. I started as an entrepreneur in resident for the venture capital firm. And then I eventually became a partner in that venture capital firm. And then another firm, at which I came to Miami then in 2006 to raise a later stage venture capital firm. I think I was probably one of the first non-Latin in a Latin American private equity firm. It was a long time ago. I don't know if I was the first, but certainly was one of the first. So I had a lot of experience doing that. And when I came back to the US for the third time to Miami in 2006, I actually, my whole career thought in dollars, despite living in London, despite living in Brazil. And I started to diversify and invest off my own balance sheet in 2006. So I created my family office, Aceana Group. Then it was just a small, really private holding company. And then eventually I started doing that full time from 2001 to start doing investing and focused on that.
Well, very good. I appreciate you sharing that with me. You've learned quite a bit based on what you've shared there. Over those many years, what's maybe a major win or a turning point that you're proud of and that really helped shape your vision and your approach? And then also conversely, was there maybe a setback or a challenge that also contributed to shaping that approach to how you work with your clients?
Good question. I mean, at the time, I suppose the challenge was to market a Brazilian fund, venture capital fund outside of Brazil. And I'll never forget, I was visiting a famous endowment, which name I will not divulge at the moment, but a very well-known endowment who they had sort of forgotten that the first venture capital funds in Brazil and even in the US were $10 million. And then they eventually grew. We were raising 300 million at the time, which is a very large fund in venture capital in Brazil. And he made the sort of slightly demeaning comment, the first funds you did was a mere hobby. And he asked me if I spoke Spanish, not Portuguese. So raising, I think that one of the challenges was to raise a Brazilian fund, and perhaps one of the, I guess, highlights, which then brought me eventually to the US and started investing, was being able to do it successfully. I felt like I was an ambassador for the country and for emerging markets. And that's put me in good stead because I've been able to connect dots. I've actually lived on 3 continents. And I feel that some of the things that I do well is I'm able to see different trends and different locations and be able to find economic, I think, successful economic investments by making comparison price points and perhaps even looking a little bit in the future. We were very early to move to Brazil. We moved to Miami, for example, in 2006, and we all know what's happened to Miami. So I think sometimes the pioneers have a few arrows in the back, and I certainly did with my fundraising for sure. I received many, many no's, but being able to sort of foresee and moving, as Wayne Gretzky famously said, you skate to where the puck will be, not where it is. And I think I've been quite good at that in connecting the cultures and the different geographical opportunities as well.
Yes, absolutely. I appreciate you sharing those couple of perspectives there, because I think that's both kind of both sides are important to how we approach life, and if we're going to be successful and learn and progress. For those that maybe haven't heard of Aceana, would you maybe describe a little bit about what really sets you guys apart? What's your mission, maybe your strategy? What's the overall value that you deliver as a family office?
Well, we are a single family office, so I don't run other people's money. I just want to make that clear. There's other multi-family offices. We don't, in essence, have clients per se, but I can tell you what I think, how we work with other family offices in a second. But I think that what we've been good at doing, I've been fortunate, knock on wood here. I've never lost money investing in a fund, and I've never lost money co-investing in a portfolio company. I have lost money doing a couple of directs, which we can talk about in a second, some of the failures that you learn from. So I think I've been very good at working with perhaps not so well known and finding niche managers that have a vertical expertise, a technical expertise. We had technology funds in Brazil with our investments in technology. I've been investing in technology for 25 years. I'm a generalist, but I think I have a bias to invest in technology. The only thing we do, but I seem to be able to find very good, perhaps under the radar managers who work very hard, or not necessarily the brand names. And with that, we get very good returns and we get very good co-investment opportunities as well.
Oh, that's great. So Aceana then spans many asset classes. I think we've mentioned that a little bit. Again, venture, private equity, infrastructure, real estate, and so forth. How then do you think about how much to allocate or diversify, to diversify across those, and how do you source deals then typically?
So I spend a lot of time just in terms of sourcing deals. I just got back quite late last night, so I'll probably look a bit tired, but I got back from a family office event in Houston. Unfortunately, we got stuck on the runway for a couple of hours because of lightning, but that's part of the travel. We get used to it. But I spend a lot of time going to family office events. I go a lot of time going to specific industry events, private equity events, and they can be very large events such as the Super Return event in Berlin, which is one of the largest. I go to smaller events as well. I go to events focused on technology, events perhaps focused more on venture capital, emerging managers. So I spend a lot of my time exchanging ideas with fellow investors, hopefully helping them with good ideas and receiving good ideas. And that's also being able to get access into some of the funds. Almost all good funds are hard to get into. It's a question of access. So I believe in helping, being helpful. I usually talk to fellow investors and say, this is what I've done recently. These are the reasons why I've done it. Happy to introduce you if you want. I'm only an LP. I'm not a GP. Please do your own due diligence. And then I'll say, if anything comes up that you really like, that you think they would be open to another family office or another investor, please let me know. So that's been helpful. So I do travel quite a lot internationally, domestically, with family office events, with industry-wide events as well.
Well, that's very good. So you really are getting out there, networking, and establishing. You've got established relationships already, obviously, and then it's all about probably building new ones too, and networking and seeing how you can help others. How can they help you, and then you can maybe help them in terms of, and then how you can help working with your clients and so forth. So with that, do you have maybe like a representative project or something that you're very that exemplifies your approach, something that hey, yeah, it really pushed the boundaries, and this is really what we do, and how that could be a benefit to others that may want to learn more.
Sure. I mean, as I said, I spend quite a lot of time looking at different funds, different verticals. We generally have invested in AI, in deep tech, fintech. We've invested in climate tech. We've invested in other things that are perhaps not so correlated to the markets. We just recently, I can tell you some of the things that we've done recently. We invested in a fund that I think has a very, very tremendous track record as individual investors since 1989. So they've been doing it off their own for the family office, and they're doing it off their own balance sheet. And it's in biotech, so they've been very strong relationship. But they've now just set up their first fund, so we're investing in that fund, and that's an example where I'm happy to mention the names or not. I don't mind one way or the other on that. But basically, what we try and do is find people with very long vertical experience, technical experience, and they may have spun out from a family office. They're not first-time investors, but they may be first-time funds. So we've done that recently in a biotech fund. We've done that in a climate tech fund. We actually did one. I just signed the documents today. Something a bit very unrelated, but very much more of a yield play, where the project is actually investing in wooden barrels focused to supplying to the whiskey industry. And
Wow,
interesting
that is
enough,
very unique. Yeah, interesting.
wooden barrels and trees both grow over time with value because they get bigger, they get more valuable. And so they
Yes.
supply that. So it's actually a very high yielding linear increase. So very different than the stock market, right? So we like to find these sort of things. We just recently invested in a fund that works on early stage children education, building them. So there's 6 million supply for, let's say, capacity of 6 million students, and the demand is 14 million. It's a problem or an opportunity, depends how you look at it.
Yes,
Those are some
absolutely.
things, or even perhaps people think of that. We just also invested in a fund that has focus. I think is the only one that's doing this, focusing on investing in physical facilities, mom and pop physical owned facilities, on patients with Alzheimer and dementia. So private equity industry have been very good at entering and buying into wellness centers, X-ray centers, dentistry, but no one's really doing this niche, which is a huge niche because unfortunately, by 2050, 1/3 of the population will have mild to severe forms of Alzheimer's dementia because we're living longer, eating too much processed food. So that's they've applying a private equity model that's been successful into a new TAM that is very, very large, and the price points are very low getting into. So things like that. And then we've done successful AI funds. We do a lot of seed and Series A investments, and we like to. What we've learned over time is to invest, get a relationship, usually 2 or 3 funds with strong fund managers that we get to know, and then we invest in those successful portfolio companies. So I have a portfolio of direct investments, probably 50 or 60 direct investments. We have about 16 or 17 funds. But as I've gotten a little bit older and more experienced, we're doing less directs by ourselves, and we're doing more co-investment with the fund managers. So they're taking those portfolio companies, training them, making them more professional. Often these companies pivot, and the successful ones need more money. And then in smaller funds, which we like, we generally do smaller funds, 500 million or less, and the venture funds are often 100 to 300 million dollars. They will say, we've invested in this next round, Russell family office, would you like to invest with us, Perry Pursue? And often we get a bigger percentage than that because we're family office. Not everyone does co-investments. So it's been a way, to be honest, Scott, I'm going to be a grandpa for the first time in March. So I'm looking to work smarter, work a little bit less. And that's been a good strategy. So I'm working less and I'm frankly making more money by doing that, believing in people.
Well, congratulations on both fronts. Congratulations on becoming a grandfather, and also on working less, but working smarter, and
Yeah.
working, being more efficient. And we only have so many hours in the day, and so much time allotted to us, and so we want to spend it the highest and best use, and that makes us happy as well too, and makes others happy. So that's good. So, the macro environment is challenging. Got inflation's up, it's down. Is it coming back a little bit? But you got rate volatility. You got a lot of pressures in the markets. Stock market just continues to go, 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 go. But there's a lot of risk factor. There's a lot of geopolitical risk out there. There's a lot of signals out there that you're wondering, gosh, where are we headed? Those are headwinds, right? They influence your underwriting, your risk tolerance, how you maybe structure deals. How then do you kind of navigate through that?
That's a good question. Basically, if you were lucky enough to pick the Mega 7 trend tech, the NVIDIAs, etc. of the world, I should have just done that 5 or 10 years ago and I would have made much more money than I have, although we've done very well. But you can't do that. No one really has that expertise. You can perhaps get lucky, get one. It's just not possible. But what we have done, we've made adjustments. I'm more of a fundamental player, and I'll give you a statistic which is very interesting, and people perhaps forgotten it. And yes, we've evolved, and stock market goes up, et cetera, et cetera. But Apple went public at 300 million. Google went public at $1 billion. Uber went public at $53 billion. So what's that mean? Private markets are maintaining longer. There's more alpha. Yes, obviously, even if you invest in these companies, they've done extremely well afterwards. But we've gone over the last 5 or 10 years into smaller, focus on seed and Series A investments and growth capital. So we don't do the large companies anymore. And we have decreased significantly our public equity exposure. Because I'm not, although my first job at Morgan Stanley, I was a trader, I'm not by definition a trader. NVIDIA could be a great vehicle still to make money, but it's about momentum. I don't think fundamentally you can justify that price anymore. And so some people are very good traders, other people are very good investors, and you can make money both ways. They're not mutually exclusive. You sometimes have to know which is the best way to go forward. So given what you said about the headwinds, given the valuations, we have actually decreased quite substantially over the last 5 years our public equity, and we've invested more in private. Now we have the cash flow to do that because of two underlying businesses in Brazil. We're a British Brazilian family. We have a real estate developer, so we have tenants, and that gives us yield. And we have productive farmland. We have rice and cattle, and every year in Brazil there's a harvest. And there's not a lot of vegans in southern Brazil, so rice and meat people eat a lot, right? So that's been good and counter-cyclical. So that gives me the ability to be a little bit more alpha seeking, a little bit more aggressive than I think some family offices our size. And I've also been a venture capitalist, so I feel comfortable doing that. So we do something I think a little bit different than most family offices like our size and most people. So our exposure in public equity is very small, probably much smaller than most.
Okay, well, thank you. Yeah, interesting how diverse you really are, and I appreciate you sharing some of that with your pretty diverse. And also what you referenced earlier, meant to kind of mention that as well, those niches that you mentioned earlier. There's riches in the niches, right? As they say. And then it's just a matter of really understanding the value and seeing, what are the trends and what are the things that you're able to see. And then, but then how quickly do you get in and then you say, oh no, we got to back out of this. But what is your time horizon?
Well, you
On
can't.
average.
You have to be. That's the challenges of private markets, right? I just went back, for example, first time in 10 years. I went back to be an LP in a Brazilian, Latin American venture capital fund, and people were, why did you do that? So Latin America has been very successful at two sectors. One is fintech, the most successful, and the other is private healthcare. And so we just committed to a Latin American fintech fund. And you may or may not know the name Nubank. It's a very large, very successful digital bank. It's now worth, I think, 35, 40 billion. So again, is it worth that price? I don't think so, but then it creates a lot of the ecosystem, etc. And then someone said, well, when do we know, Russell, when will you be right? If you're right or wrong, I said in about 7 years. So you have to make sure when you invest in these private markets, you have to make sure you have the ability to be able to withstand that illiquidity and hopefully get paid for it. And what you do, we've been doing this since 2001. So if you do it on a regular systematic basis, you then build in liquidity because you get obviously distributions. And fortunately, our distributions are much larger than what we put in terms of what we invested. So you get a multiplying effect, and then you can reinvest a majority of the distribution. But still, if you have very strong returns, which we do, then you can invest much more and you still have liquidity. So it builds on itself. The thing is, you've got to build it systematically over years and just realize the first few years you won't have that distribution mechanism. It usually takes 5 years when you invest in a fund before you see your first distribution. That's kind of what you have to think about. Depends on what type of fund, whether it's a private equity, whether it's yield basis, and there's certain things that have more current yield. So you can build in liquidity and some yield within the private funds that you do. But if you're going more on venture growth capital, it can be 4 or 5 years before you get a distribution. You can get yields sooner than that, but that's not really large capital gains.
Okay. Yeah. Thank you for sharing me, what that sort of what your time horizon is and some of the principles around that. So, you may have mentioned it a little bit, but, you talk about AI, big data, tech, it's transforming investing. How then is Aceana leveraging AI, analytics, other tools, maybe in deal sourcing or portfolio monitoring or, obviously managing risk or value creation?
So it's been a bit easier to invest in. We've invested in deep tech AI, and it's converging a little bit with that. Tech is very omnipotent. AI is almost everywhere. So the first thing we did, we actually found a good manager that we thought it has proven to be a very good investor in the AI ecosystem. That was really our first step. Using AI as an investor has been still a bit more challenging. And I say what it's been good at so far, if you use AI, it's quite good at making summaries of legal documents, of PPMs or documents that are quite regular, but it's not quite yet. We're trying. We've invested. We've done some beta testing, whether it's a portal. And I think a lot of people are at this juncture where we would love AI to be generative and we've tried it in portals, putting in the portfolio companies of various fund managers, putting in the annual reports to see if we can rank them forward thinking to see which are the best, given the sectors, given the strategy, given their history, which ones are the best. Replace a little bit of my human experience and gut feel. And so far, we have not been successful, not even close. It will a long way.
I hear that from others as well. Yeah, I hear that from others as well too. That human touch, that human intuition, that human understanding is still going to be very, very, very important. It may be forever. And, I don't know that AI will ever get to that point. Yeah, 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 absolutely. Well, I think we also just need that. I think that people want that human touch as well too, right? So,
And Scott, the other thing is, as you probably can realize, good funds are hard to get into. It's a game of access. If you don't have those relationships, and we have the databases, we know the good brand names. Now we're also investing in the emerging managers, the next good brand names. But even then, if you don't have a relationship with those managers, you won't get in, you won't get invited. And AI is never going to replace that relationship. And that's why I travel a lot, is to identify and create those relationships.
yeah, very important. And indeed, AI is there. It's going to continue to grow. It's going to continue to get better and better. But that human touch is going to be very, very important. Those relationships, it's really, really difficult, if not impossible, to replace that really understanding each other. So for emerging, as we kind of wrap up here, for emerging family offices or smaller funds, maybe individual investors who are listening, what's one piece of advice that you'd like to give them as they plan their investment strategy or build out their portfolio?
So I would say this is how I've evolved. So if I'm looking specifically at a smaller investor who's just starting, I would say two things. One, you have to start slowly. And I would say you start slowly, probably by thinking about doing a fund of fund. If you've never invested in private investments before, you want a diversification. So when I first invested in 2006 off my own balance sheet into a venture capital, I realized that one, I didn't necessarily at that time have enough money to get into the top venture capital fund. And they didn't know me, so I wouldn't get in anyway. Again, going back to access. But I wanted diversification. I didn't know enough, and I didn't want to choose just one fund. So I did a fund of fund that gave me access to several different funds. You pay a little bit more fees, but it stops you from making a big mistake, right? Then you start investing in the funds. You figure that out. The next process is I understand the market more. I'm going to invest in these specific funds. And you go from being more general to more specific. And then the next step is, frankly, getting those funds are very much focused on a certain vertical and being able to then do co-investments with those successful fund managers. But this has been a journey of mine that's almost 20 years old. It's not something, so you have to be patient. That's very important. Number two, listen to your gut. As I get older, my gut and soft due diligence skills have become more important. if you have that feeling that that person just is not aligned with your values, you just don't think that person is really someone you want to have a cup of tea with or a beer, there's something there that doesn't feel good. Listen to that. Don't do it, because almost anyone can make a great looking pitch book deck these days. They all go to great schools. That's not enough. And looking backwards isn't enough. Looking at previous track record, going forward again. What are the trends? And can you execute? You're betting on the jockey. You're betting on the athlete. AI is huge. There's a lot of FOMO. You can make money on AI, but you got to make sure you're doing it with the right type of person. So it just takes patience. So start slowly. Assume that if you lose, unfortunately, I've never lost money on a fund, but if you do, you're probably not going to lose all of it unless you work with someone, unfortunately, who's corrupt, or we don't want to get in that. So that's why the soft is so important. You can take a small hit on a fund if it's 3 or 5% of your net wealth. Start with your liquid markets and then build it out over time. It is a systematic long-term investment class, and it does pay. We're very happy with our long-term returns, and it's certainly been something that we've decided over time. And I think everyone should do it, but just take the small methodic process bit by bit and be patient and really, really look at the people, because that's in the end you're betting on people who are better at this than you are, and you got to make that judgment.
I really appreciate, Russell, your time today and for sharing sharing with us your insights, the things that you've learned, where you see things headed. You seem to be very well. I think you have a very optimistic outlook on where we are headed, but you're also very cautious at the same time as well too. You see the power of technology and AI, but again, it's the relationships and having access to people that have opportunities that you can then go take advantage of is going to be very, very important. So, for listeners who want to learn more about Aceana Group or connect with you, what is the best place for them to go?
Well, Scott, I think the best place is probably feel free to reach out to me by email. I'm happy to. I often set up Zoom calls, exchanging investment ideas. I always learn talking to people, so I'm very open to sharing. I have to give you my email. It's russell.deakin, so it's my name, right? RUSSELL.DEAKIN at Aceana Group, and that's ACEANAGROUP.com. People can reach out to me, say that they found me, they looked at the interview. I spent a lot of time exchanging ideas with people. I'm happy to do it. I always learn, and I think that's the best way to operate. So I like to be positive. I like to be realistically optimistic, and if I can learn something and help every day, then that's hopefully keeps us happy, healthy, and wise, and we'll live a long and happy, prosperous life. That's my goal.
Thank you very much, Russell. I really appreciate that. And again, this is Scott Hurst. And if you liked what you heard, certainly rate and subscribe this. And check out Aceana Group. I really appreciate, Russell, your time today.
My pleasure. Take care now. Cheers.